Welcome to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Kevin and Joe Deitrich. They are partners of First Choice Financial Services Incorporated. And to our viewers at home, are you thinking about retirement and yet you're really afraid of what taxes could be? Do you have any tax planning strategies in place? And finally, we're also going to talk today about the big, beautiful bill. So to the viewers at home, we're talking all about taxes, tax planning, and our final segment, the big, beautiful bill. And how does that impact you? Joe, how are you today?
I'm blessed. How are you doing?
Very blessed indeed. Thank you for asking. Kevin, how are you?
Ditto. I'm blessed as well. You?
Blessed.
Amen.
I love that. That's
Good to
the
see you
best
again.
way to wake up during the day, right?
That's
Or
right,
during the
that's right.
day. We're awake now
That's right.
in the morning.
It's the best way to wake up, period.
Thank you.
That's
Doesn't matter what time it is.
That's right. If you take a nap, you can wake up blessed after the nap.
I love it. That's perfect, actually. So when you think about planning strategies, obviously viewers at home, you're probably wondering what sort of tax burden am I going to walk into when I finally say I don't want to work anymore? Well, the blessing is working with an independent fiduciary advisors like both of you are, you're able to really nip the tax problem in the bud by utilizing some planning strategies. So let's talk a little bit about that, Joe. How do you help people understand the landscape of taxes in retirement?
Yeah, absolutely. Well, here's what we want to remember. Just because we stop working doesn't mean that taxes stop. So the best way to start handling that is to plan early. The earlier we start planning, the more impact we can have in controlling our tax return, right? So, we always like to start with education and kind of going through all of the different sources of retirement income that are still going to be our tax burden. Because that's important. A lot of people don't think about that. They think, well, I'm going to stop working, my taxes are going to go down. Not necessarily.
And a lot of people feel that way. I'm glad that you brought that up. Kevin, how do you answer that question? If I came in and sat with you, I said, Kevin, you know what? I'm going to retire. I'm not going to be working anymore. So obviously my taxes will go down, right?
Maybe.
Yeah.
Here's the thing. In First Choice, we do everything. Every guidance we give you, every education, every plan we put together has tax planning behind it. I think that's what differentiates us from everyone else, that we look at it from a tax perspective. Because outside long-term care in retirement, taxes may be your biggest expense.
Wow. Okay.
So looking at it from a tax perspective, every decision or advice we give you, every decision you make should have a tax planning focus to it.
Okay.
And so because taxes don't change when you retire, they can come down, but they also may increase most of the time.
Exactly. So
Wow.
your 401ks, your IRAs, all of these retirement accounts, you've been putting money into those tax deferred, right?
That's
We haven't
right.
paid tax on them. So here's a nice little visual, right? That's 100, 200, 300, 400, 500, right? Well, what if
Okay.
that's 1,000? That's 500, $500,000 you saved in your 401k.
Okay.
And say your taxes do go down a little bit, maybe you're in the 22% tax bracket. Well, that's more than $100,000, right? So
Wow.
you've lost, that's just 20%. You're in the 22% tax bracket.
And this goes away.
Yep,
Uh-oh.
it's gone.
Yikes.
Yeah, so we've got,
So I've
I've got
less money.
$500,000, I got $1 million. Well, you don't, because some of that belongs to the IRS. You just haven't given it to them yet.
So Uncle Sam gets a cut.
Yep.
Yeah, and then when this passed through beneficiaries, if you have this remaining and you want the beneficiaries to split in half, this goes to Uncle Sam, and now you have to split that.
Oh my gosh, so I just lost more. I don't like this game.
Right? Let's
Yeah.
start over, right?
Let's start
so
over.
What can we do now? Because the best time to plant a tree was 20 years ago. The second best time is today. What can we do now to better ourselves 5, 10, 15 years down the road?
Yes.
The sooner we begin, the more we can make positive changes.
And so many people that are entering the retirement years, if you will, they are grabbing their Social Security benefits. Are those taxed? Are those something that people should be thinking about as well?
Yeah. Interesting, right? I mean, we have our live events, and so how many people think Social Security benefits are taxed? And it's split 50-50. There's many people out there that don't think you're going to pay tax on your Social Security.
Okay.
But you will. There's certainly a tax structure around it, and we kind of go through that in our educational seminars as to what that looks like, but there's definitely a tax obligation on your Social Security benefits.
Wow.
Yeah, there's something called provisional income. And I usually ask Has anyone ever heard of that? No one's ever heard of that.
I haven't heard of that.
No.
What is that?
Yep.
That's how they determine how much of your Social Security is taxable.
Wow.
So if you're on Social Security, if you're working, let's just go backwards a little bit. If you're working, you're not on Social Security, so your tax structure is the way it is. There's tax brackets, there's credits, there's deductions that you have. When you go into when you add Social Security into there, it gets convoluted. So you actually have to go through provisional income. So all your income goes into this formula. Half of your Social Security, all of your other income goes in the formula. If that number, that after you add all that up, is at a certain level, then you will pay tax on Social Security. If it's under a certain level, you will not.
And it's tiered. There's different levels. You know, it's never simple, but there's a process that you go through to figure out what that is. And that a lot of times nobody's heard of that. And so that's certainly going to be a piece. We want to educate on that, but that's not the only source of our retirement income. I would certainly hope not. Typically, it's only a portion, maybe a third to 60%. There's a range depending upon what your needs are and your standard of living, but it's not going to be your only income in retirement. So we need to plan, where's the rest going to come from?
Yeah.
Right. And when you hit 73, don't you start taking your RMDs? What happens there? Are they taxed as well?
They are.
They are. Okay.
At regular tax brackets, whatever you're in. And then if you're born below 1959 or lower or earlier, then the RMD age is 73. If you're born 1960 or later, the RMD age is 75. That's good to know.
Okay.
So they bump that up a little bit.
That is good to know.
That's all of your qualified accounts, which is your IRAs, 401ks, 403bs, TSPs, wherever those pre-tax accounts, retirement accounts were in. That's the money that they add up, and that's your RMD. That's when you're responsible for the RMDs.
Okay.
And
Roths are outside of that.
Okay.
So where's the bulk of our money as we approach retirement? In those qualified accounts.
Tax-deferred, yeah.
Yeah,
That's
and I think
scary.
what some people don't think about is the present value of our accounts versus what the account values are going to be at age 73 or 75. So if you're 63 or 65 and you've got 10 years for that money to grow in those accounts, well, that's wonderful. We certainly want to see those accounts grow.
Right.
But if we're calculating what maybe my income or taxes are going to be based upon the present value of those accounts, well, we might be making a mistake because those are going to grow. I mean, what if those things double in 10 years? Right. So now all of a sudden we're getting forced income and forced taxes on that income that we didn't expect. So that is a big thing that we want to start working on.
That's why taxes could be a big expense in retirement. People don't think about that.
No.
Well, I just want to grow my money. Well, there's consequences to that.
Most definitely. And all of these things need to be taken into consideration. I know we're going to take a commercial break, but let's talk a little bit about the first, excuse me, I was going to give the wrong one, taxfirst.net. I was going to give the other quiz. We could give both, but taxfirst.net. What is that exactly, Joe? Talk a little bit about that.
Taxfirst.net. That's going to take you to a landing page where you can put in some information and just what I was talking about. Present value of what our IRA accounts are, or our qualified accounts are, and what that's going to look like is my tax obligation for the rest of my life. And what would it look like if maybe I did some simple changes or some planning, worked with somebody like us that sat down and started to do some adjustments? How much can I save on that tax bill over a lifetime? So go to taxfirst.net. I almost did the same thing. Taxfirst.net, and you'll be able to take that quiz and get a clear picture of where you're at.
Joe, thank you so much. Kevin, thank you so much. Viewers at home, pay close attention. It is taxfirst.net. We got it right that time, taxfirst.net. Please go ahead, visit that website. If you don't have a pen handy, grab a smartphone, click the QR code at the bottom corner of your screen. If you'd like to schedule a complimentary consultation with Joe and with Kevin, please call in to 888-959-2743, 888-959-2743. We're talking all about your retirement years and your potential tax burden. When we come back, we're going to use some tax planning strategies to make sure that you can keep more of your hard-earned money. You want to give too much to Uncle Sam. We know he needs some, but you want to keep as much as possible. We'll be right back momentarily.
I was in Colorado, actually, pastoring a church. I just felt a disconnect or a lack of peace at the church there, and so I was praying, asking the Lord for direction. So I just felt like He had given me a burden for my dad. He was working 60, 70, 80 hours a week at his age, and I just felt burdened for that, and I wanted to, help him out. So I approached him about it one week where they were visiting over Thanksgiving, and he says, God didn't tell him that. We laughed, but we prayed about it further, both of us, and we just felt like the Lord was leading that way, so we made the arrangements and moved my family back home to Pennsylvania. And so I was helping my dad out part-time, sort of. But the more I learned the business, the more I understood what he does and what benefit I can have for clients and people's lives. And it was just a calling, like my dad says, it's a calling for him, and I think it's a calling for me. The Lord prepared me for this place, in this time. So I got my license and started selling, and I was successful. I was doing well, and once I got my license, the business kept doubling. So we kept increasing our revenue, our profits, and then helping more clients in the long run.
Welcome back to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Kevin and Joe Deitrich. They are partners of First Choice Financial Services Incorporated. In case you missed that website before the commercial break, once again, taxfirst.net. Take a few minutes out of your time today to go in, put some information about your situation, your income, perhaps your tax bracket. You'll receive an email that, again, will show you what your current tax burden is, but don't be afraid. This segment, we have solutions, and everyone loves solutions to the problems, and that's what this is going to be. So Kevin and Joe, I'm going to start with one of the solutions that you're both so passionate about when you're implementing tax planning strategies for your clients, the Roth conversion. Mm-hmm. Kevin, why is that something that we should talk about as a solution today?
Oh, it's so important. Roth conversions are so important. Let me give you an example. Let me back up real quick as I give you an example. To put money into a Roth, you can do a contribution, which is there's a limit to that, $7,000. If you're below 50 or over 50, it's $8,000.
Okay.
But if you have to have earned income for that, so you have to be working. Okay, so let's say you're retired, you're not working, and you want to put money into a Roth. Well, you can convert existing IRA funds to a Roth, and there's no limit on that, so it's as much as you like to, but you pay tax on that.
Okay.
So we have to do that systematically. So during our workshops presentation, we spent a lot of time on this in the tax portion of the workshop. I had a couple come in that were, they decided to do business with us. We started a Roth conversion planning system. So we did that every year, moved a little bit of money from the IRAs accounts to the Roth. Now he's working currently. So we have to be mindful of the tax bracket that he's in.
Okay.
Stay in that tax bracket. If he's in the 12 or 22% tax bracket, he's good paying the tax on that and converting that money ahead of time, being proactive. That's what we talked about last segment, being proactive in our tax planning. Then he was able to convert, let's say, $20,000 or $30,000 over a 2 or 3 year period. Okay? So he came in, he called me and says, Kevin, I need a truck.
Okay.
I said, why do you need a truck?
I was going to say, what kind of truck? But go ahead. What are we talking
well,
here?
I took my car in for inspection, my truck in for inspection. It won't pass inspection. Very similar to another story I had last week, but this is a different gentleman. And I said, okay, so come on in, sit down, we'll go through there. So we did. And he said, well, here's your tax bracket. Here's how much income you have currently come in. You have about $20,000 that you can play with to get you into another tax bracket. Go from a 22 to up to 24% tax bracket. And he said, I don't want to go into to the 24. I said, I don't want you either. So let's do this. You have money sitting in the Roth and you have money sitting in the IRA. The truck's $30,000. Mm-hmm. So we need to take $10,000 out of the IRA, $10,000 out of the Roth, and $20,000 out of the IRA. That gave him the $30,000. He only paid tax on the $20,000.
Oh, wow.
That was in the IRA.
Okay.
Okay. So the Roth conversion, because we did that planning early, even while he's still working, we're able to do that. Okay. He was able to save on taxes.
Oh my gosh.
He got the truck cash. He was thrilled.
I can imagine. I would be thrilled too.
Didn't have to take out a loan, nothing like that. But that started with proper placement of where it is, the early planning, and it wasn't as simple as what Kevin just described. You know, there was back a whole lot more math that went into that, right?
A lot of math that went back into that.
Because we want to make sure that that's the right decision. Yep. Yeah.
So he's very helpful, very encouraged that he has a team member like us,
a
football coach like we did last show, right?
Yes.
On his side, that doing those proper planning and educating him on the importance of a Roth conversions. So that's a critical consideration we can do as we approach retirement.
And I love that he came to you first before making a decision that was
Yes.
outside of the context of his plan. That's something that's
Yeah.
so important to
Yeah,
talk
that
about.
shows accountability. That we're on the
100%.
same team.
Yes.
We're going for the same goal, and that is to have a stress-free retirement, happy retirement, not having to worry about the income coming in. What am I going to do if something happens? Kevin's got this. First Choice has got this. They got your
Yes.
back.
Yes, it's all about that. Thank you so much,
you're welcome.
Kevin.
And a cautionary piece of all of that is that not every conversion is right in every situation. It needs to
Right.
make sense for what your current tax brackets are, your projected tax brackets are, what your appetite is for that, and the planning goals and objectives. So for those of you that hear like Roth conversions, I've heard of that. I can do that. Boom, boom, boom. 1, 2, 3 steps. Not a problem. Be cautious because it has implications just now and in the future. We'll make sure that if we're doing it because it benefits you in the long run.
Joe, thank
And
you.
it has
Kevin,
to be
thank you.
systematic.
Yep.
We do workshops every month, and we were talking about this very thing in the workshop, and the guy raised his hand and said, "You have a question, sir?" He said, "Yeah, I just talked to my financial advisor about the same thing." He said, "Well, let's just move all your money from IRA to Roth." I said, "Well, can I ask how much money you have?" He says, $225,000 in my
Okay.
401k that he says I should move to Roth. Just pay the tax, just take the hit and pay the tax. I said, "Well, I just showed you right here simply over the last 10 minutes how we can do this systematically and reduce your tax burden overall. You don't have to take the hit."
Yeah.
So having someone on your side that's looking out for your best interests is so, so important.
Most definitely. And again, it is so much accountability, being a good coach, being a good steward, if you will. It all works together beautifully. Joe, I want to ask you about tax efficient asset placement. Talk a little bit about how that can be a solution for us.
That's a bit of a mouthful, huh?
It was. Let me say it again. Tax efficient asset placement.
Yeah, what does that even mean, right? So let's think about, we've heard of asset allocation, right? How many stocks, bonds, cash do I have? But asset placement, what kind of investments are in each account? And this can be very important. Do I have, if I've got a tax-deferred account, an IRA, 401k, 403b, and I'm putting it in there and that thing is churning and there's a lot of trading going on in there, or there's dividends or interest, that's really all deferred, right? But if I have a non-qualified or an individual account, which I am responsible for whatever tax implications that account does year over year, now I'm in a totally different ballgame. It matters very much about what I put in that account. So making selections, now that sounds like, well, I might be limiting my investment options. Well, we may just need to be looking at an overall holistic approach as far as I want to have certain assets in my plan, but in this particular account, I'm going to be selective as to what I put there so that my interest income, my dividends, my capital gains, all of those can be controlled, because that's a completely separate tax implication as itself. The IRA, the income, the Roth, we have that, but our tax implication of short-term capital gains, long-term capital gains. I just met with somebody who they've had investment accounts in the same position since the 80s.
Wow, since the 80s.
Well, guess what? There's a bunch of capital gains sitting in there,
Oh,
you
yeah.
know? And that's something that needs to be dealt with. And I find that a lot of people don't think about that until it's time to start drawing them out. And then it's like, wait a minute, I thought this was going to be, I didn't think I was going to have to pay this kind of tax on this amount,
Yes.
And it's also careful to kind of coordinate all of these pieces as well, because we don't want to surprise sale of stock or interest or dividends that's kind of throwing our plan off that we've been working all year on. So we want to look at that ahead of time.
Most definitely. Makes perfect sense. All of these are amazing solutions. I think we should give the viewers at home a chance to come in and meet with you. What do you think?
That sounds wonderful.
To our viewers at home, there's a number to call on your screen. That number is 888-959-2743. And today's show, as you know, is talking all about taxes and proper tax planning. You really need to take control of your financial future. How do you do so? You book the consultation today, 888-959-2743. There's also a website that you can visit. It's taxfirst.net. taxfirst.net. Put in a little information about yourself. You can put in your income, put in your tax bracket, and take a look at what your current tax burden is today. And then it'll show you what it would be if you made a few changes, a few planning strategies like we've spoken of today. Again, 888-959-2743. Don't go anywhere. Don't turn the channel. We are actually going to come back. We're going to talk about the big, beautiful bill and how does that affect your retirement plan overall. Stay tuned.
According to the Transamerica Retirement Survey, over 1/3 of American workers have already dipped into their retirement savings to handle day-to-day expenses, and nearly 40% have reduced their contributions. For those approaching retirement with significant assets, this may sound like someone else's problem, but it's a warning worth noting. Economic pressure doesn't discriminate. High net worth individuals are just as vulnerable to reacting emotionally during times of financial stress. The key is discipline and a plan that evolves with changing circumstances. Having a tax-aware, income-focused, and flexible strategy in place can help you avoid short-term mistakes that impact your long-term goals. Because real success in retirement isn't just about what you've saved, it's how you protect it and use it.
Welcome back to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Kevin and Joe Deitrich, partners at First Choice Financial Services Incorporated. We're talking today all about proper tax planning so that you're not hit with a tax torpedo during your retirement years. And in the commercial break, Kevin and Joe let me know that actually it's the one big beautiful bill. I think I opened up with big beautiful bill, but we have to make it correct. One big beautiful bill, gentlemen. Thank you so much.
Yep.
I don't want to get that wrong. That's important.
Right, sure.
So let's talk a little bit about it. What is the One Big Beautiful Bill Act?
Well, there's been a lot in the news about the One Big Beautiful Bill Act. And we kind of like to distill it down to a couple of points that most people are really interested in and how it impacts them as we talk about our retirement planning and retirement years. So foundationally, the Tax Cut and Jobs Act that has established our current tax brackets, they were set to expire at the end of 2025. Those have been made permanent. Okay, so that gives us kind of a foundational piece of all of that. And that also means that the standard deductions that we had been established have continued, and then we've kind of expanded on a little bit with some changes that are helpful for some seniors. So Kevin, you want to kind of talk a little bit about those additional standard deductions?
Yeah, so we go through this at our presentation now because it's very important to understand how this correlates and it affects the seniors in our area.
Okay.
So the deduction, the standard deduction that we have from the tax act that Joe just mentioned was this year, 2025, $30,000. Married, filing jointly couple, $30,000.
Okay.
$15,000 for singles. Now, with the One Big Beautiful Bill Act, they increased that to $750 on top of that.
Okay.
So for a married couple, that equates to $31,500.
Okay.
Standard deduction. Now, if you're over 65, you get additional standard deduction, which was $1,600 per person if you're married, filing jointly, or $2,000 for single. That's $1,600 per person for married, or $2,000 for single. Additional standard deduction on top of the regular standard deduction.
Or if you're blind.
If you're blind, that's
If you're blind,
Yeah.
okay.
So 65 or blind.
Yeah.
Okay.
So what the One Big Beautiful Bill Act gave you was additional $6,000 on top of the $1,600.
Oh, wow.
So they just added $6,000 to the additional standard deduction, period.
Interesting.
So if you're
Okay.
single, it's $6,000 on top of the $2,000, which is $8,000. If you're married, filing jointly, it's $6,000 on top of the $1,600, which is $7,600 per person. Now, if you do the math at home, that's a lot of money.
Oh,
Okay.
absolutely.
$31,500 plus $7,600 per person if you're married, filing jointly. That's $46,700 of deductions. So,
Wow.
that's only good from 2025 to 2028.
Right.
2028.
That additional $6,000.
Okay.
There's always an asterisk, right? There's always some
Yes.
conditions. So the time frame, and then there's also some adjustments or phase out periods as to if your income is to a certain level, it starts to reduce that additional standard deduction. So there are some caveats, but this is kind of the broad brush scope of what those changes are. And we talked last segment about Roth conversions and tax planning. And so we have a few years that is in this special time period that's going to allow us to do some additional things with the Roth conversions or with capital gain harvesting and smoothing out some withdrawals on our IRAs. So we have an opportunity over the next couple of years, and we really encourage you out there to take that opportunity to sit down with us and see how this might impact your individual plan. But this is definitely an opportunity for everybody to take a look at their retirement funds and their retirement future.
This is very, very important that Joe just mentioned, that you guys sitting at home, take advantage of this. Come in and meet with us. See how this will benefit you going forward. Let's take advantage of the laws that we have and what he's given to us here. Trump made a statement as he was running that he's going to eliminate tax on Social Security.
Yes.
Okay, that has not happened because he cannot legally do that. But what they've done with this One Big Beautiful Bill Act is try to reduce the tax burden on Social Security. And here's what they said: that while Social Security taxation wasn't directly changed, the new $6,000 senior deduction provides additional deduction for federal tax liability for seniors 65 or plus.
Okay.
It has been published that combined with the regular senior deduction and standard deduction, approximately 88% of seniors will have zero federal tax on Social Security benefit.
Wow.
So if you actually sit down and do the math, they're saying that this changing the $6,000 additional for those in the next couple of years with the increase of the standard deduction will eliminate approximately 88% of seniors will have zero federal tax on Social Security.
Wow, that's incredible.
So let's take advantage of that.
Yes,
okay?
this is the
Even
perfect
those
window.
that are maybe not going to fall into that 88%, we can still reduce the tax that you pay and maybe do some Roth conversions in result of these additional deductions.
Most definitely. So this is the perfect time for people to take action because the window of time will expire 2028. So why not take advantage today to avoid these tax time bounds?
It takes effect this year. So it's not too late. Come on, call that number, go to taxfirst.net, do the quiz there. We'll get the results of that. We'll give you a call to follow up with you and see if you have any additional questions. So we have to be proactive as advisors. You guys have to be proactive as those sitting at home. Call us, take care of this.
Kevin, thank you so much. Joe, thank you so much. To our viewers at home, take action. Take care of this today. 888-959-2743. 888-959-2743. The website to visit, taxfirst.net. taxfirst.net. Click the QR code at the bottom corner of your screen. This is the perfect time for you to make changes. Be safe, be happy, and be blessed. We'll see you back 1 week from today on Mid-State Money Talk. Take care.